Mortgage rates climbed to the highest point in over 23 years, and this is putting significant pressure on buyers. Will this in turn lead to deflating home prices as more pressure mounts on buyers? Will we see the prices soften? Let's take a look and see what the effect is going to be overall on the real estate market.
I'm Kiwi of the coast, the agent with the most.
Helping you maximize and sell the value of your coastal home. Right, let's dive into those rates. Mortgage rates climbed to the highest level that they've been in 23 years, putting a lot of pressure on the market. The average for a 30-year fixed rose for a third week, reaching 7.31%. That's up from 7.1% last week, Freddie Mac said in a statement on Thursday. A year ago, the 30-year fixed rate was 6.7%. Mortgage rates have topped 7% for the last 3 weeks, and this has really put some pressure on buyers, cooling their enthusiasm and also putting sellers under pressure. The survey rate for borrowers who put 20% down for a purchase of, let's say, $600,000, this is translating to a mortgage principal and interest of $4,118 per month. And this is 58% more than it was in early 2022, just before the Federal Reserve started putting pressure on those interest rates and raising them. House hunting fallout? Well, it certainly trimmed the enthusiasm of those buyers out there looking for homes. Contracts to buy previously owned homes are down 19% from August 2022. The steep drop in pending sales for August, on the heels of already slowing sales over the summer, suggests certainly the market is cooling. Total home sales this year could be as low as 4.2 million. We haven't seen those numbers since the Great Recession 2010. Purchasers' buying power certainly has been crushed because the math is just not working out for those home purchases. Dulled home prices? Well, certainly to date, we've seen home prices certainly dulled. And in 2000, when rates were last this high, home prices rose by 6% that year and 60% through 2007. And this is according to FHFA indexes. For the 4 weeks ending September 24th, we've seen home prices drop on 1 out of 15 homes. That's the highest level since November. However, buying a starter home is now more expensive than renting in all but 3 of the top 50 metro areas. And this is why it explains why buyer demand is expected to remain low. So why the rise? Well, in 2000, we had the Fed trying to cool off those high rates generated by highly speculative technology stocks known as the dot-com boom. And in 2023, we saw mortgage rates spiking because the Fed's continued efforts to try and bring down inflation. It's made progress since 2022 when inflation was running at 9.1%, but the Fed says it's still got a lot of work to do. Fed's preferred inflation measure, the Core Personal Consumption Expenditures Index, that's a mouthful, is currently 4.2%, which is more than double the Fed's target of 2%. Now, economists expect that it to be 3.9% when the new results come out in September. This week's rate surge is certainly in line with higher for longer thinking after the Fed's recent policy meeting. While the Fed does not set mortgage rates directly, there's certainly correlation between what the Fed does and mortgage rates. Mortgage rates tend to track the 10-year Treasury, which move based on a combination of anticipation of what the Fed does and economic activity. The yield on that 10-year Treasury rose to 4.6%, and a week ago it was 4.3%, so you can see what's happening there. Make sure you click on the video that's on your screen right now so you can watch the next video in my market update series. That way, keeping yourself informed as to all the changes as they take place. Click there now, and we'll see you there. The Room.